Welcome everybody to this week's Intelligent Property Investor Masterclass. Now I'm coming to you today with a big lineup. I'm going to whiz through it because there's a lot of economic data that's been coming out. I really want you to understand it because when we understand what's happening in the market, we can actually start to take advantage. And by taking advantage of the market, what that means is we're making money. So what are we going to be covering today? I hope you're enjoying these weekly updates that I'm doing for you. But what we're going to discover today is I want to address the trade war with China. I want to talk about that and what it means for Australia. I want to talk about the clearance rates and what's happening in the market and what the market's actually telling us right now. And I want to talk about how parents are helping their kids like they never have before. And I want to go into a little bit of a history lesson about women and financial success. Since we've had the International Women's Day this week, I thought it'd be great to actually include some of that. So let's talk about the trade war. Now, with the trade war, they're the two leaders looking at each other, or not actually looking at each other, but anyway. What does it really mean? Like, what does it mean for Australia? It all happened and it started really with ScoMo saying we'll take all of Hong Kong because of these national security laws that China was implementing on Hong Kong. Now, let me just, before I get into this, I want to say this is not about the people. You know, this is not about the people. This is about the government to government thing. What is the government to government, egos and headbutting, and what does that mean? It's not about the people. It's about the leaders headbutting and a bit of political posturing and stuff like that. So it all started with the Hong Kong thing, really, and it started with a few cartoons and other things. And China was basically saying, and the COVID, being held accountable for COVID or inquiry into COVID. Not that they were, I don't know, doesn't matter. The fact is, we've got a problem. So because there's a lot of freedom of speech over here and there's not in China, China didn't like some of the stuff that was being said over here and at the government level. So they started banning some of our goods. And in banning those goods, it obviously started to hurt Australia economically. So it's interesting, though, when you look at China's investment into Australia, it's been petering out for some time. It peaked over here in 2016. And then we started to see it decrease. And a lot of that was due to, up to 2016, we were lending to Chinese nationals to be able to borrow and buy property here in Australia. That all stopped with, with prices going crazy in Sydney and Melbourne, etc. And you can see there at an individual level and across the board generally, that's been petering out. So from an investment perspective, we're not seeing the big investment coming into Australia like we were, say, back in 2016. But we've really been feeling that for a while, long before the trade war really kind of came out. Then it started to affect things like, our lobsters and our beef and our barley and, those kind of industries. They started to go, well, we're not going to take any more of that. We're going to put a big tariff on so nobody will buy it. It's interesting how the posturing has actually been made here. Now, this just picks on barley. I've just taken barley as an example. And what you see here is barley exports to China and barley exports to the rest of the world. Now, the thing that I want to mention here is with something like barley, we can use it for fodder, but we can also use it for making beer. Let's face it, that's what it's used for. So there's going to be a certain amount of demand across the world for that product. And with that, then, you think, okay, well, if we were exporting to China's still got that demand for the same amount of barley. So China's going to go and buy it from somewhere else. But at least in the short term, there's still the same amount of barley being produced. So whoever's China's buying it from now, whoever they were previously selling it to is in the market to go and buy barley because China took it all. So we can sell to them. Now, this is the case where we start to have a look at some of the products. Not all of them, but some of them this will be the case for. And I remember at the time when they first picked on barley, there was a ship full of barley heading from here to China. And literally, the thing just diverted to another port and sold it there. That's how quickly. They didn't dump it in the ocean. It wasn't any of those things. It just got diverted to another port, and that's where it was sold. So we are seeing a fair amount of that, particularly where there is a constrained production of that particular product, and it's also a product that it has a definite demand. So one way or another, it's going to go somewhere. Somebody still wants barley. Somebody still wants to make beer. Then we go to the displacement from China, and this chart's really quite important because what we're talking about here is coal. So it was another one that I jump up and down about, and the displacement and how basically what we had in China coming down here with this dotted line, it was picked up by selling that same coal to India and to Jakarta. Now, the other thing that needs to be noted here is with some of these products, not that coal's one of them, but some of the products where quality is an issue, like our lobsters. We've got the most beautiful, beautiful oceans around here for lobsters, and fresh and clean and all of those kind of things. Our wines are second to none, all that kind of stuff. There's an issue with quality. So China will, and our beef, again, it's quality. We don't have the chemicals and other things that a lot of other countries do. So they will have their own internal problems by not taking our milk, our whatever else that we're getting from here. This is a chart here you can see here of the areas in our exports that are at risk. Now, low risk is our minerals. That hasn't missed a beat. They still want particularly the iron ore, particularly there. So it's a low risk. Then we see gold. Gold is actually put in there as a medium risk, but I don't see it as a medium risk. I actually see it as a low risk because, gold, particularly in uncertain times, is a commodity that a lot of people run towards. So I actually see that as a low risk. The fossil fuels, the agriculture are low risk. The ones that are at high risk are education and tourism. Now, these are the ones that we're seeing massive slashing in, and I think this will be down for a long time, and from China may never recover in the next 10 years. Who knows what happens after that? But I think that is a real risk area. So we need to be more market oriented in other areas to pick up here, because yes, that's going to be massively affected by China. Chemicals, manufacturing, machinery and beverages, etc. So you can see that they're considered to be relatively low risk. Now, this is what I was talking about before, about the fact that there's still a demand for a particular commodity. And we saw here, this is Bloomberg's, and you can see there the spot commodity index, and how, through COVID, there was actually an increase in demand for a lot of things across the board from a commodities perspective. But there are going to be some fallout. And the fallout, as I said, is going to be in the student market particularly, and this really shows that, because pre-COVID or pre the war, or whatever you want to call it, the argument that we're having with China at the moment, we had it was worth about $11 billion. So most of our education dollars were coming from China. India, 3.8 billion, and 1.6 from Nepal. I was actually astounded that 1.6 was from Nepal. I thought it'd be much lower than that. But anyway, so the issue is the non-essentials markets that are not capped, aka tourism and education. And when I was exploring this, I thought, whilst it will have an effect in some industries, it won't really have a big effect in others. I came across a Chinese proverb that I thought was interesting, so I thought I'd include it today. And the Chinese proverb says, "Kill the chicken to warn the monkey." And I started to think about that. I go, that's exactly what's going on. They're picking on Australia and making Australia the big, the baddie, if you like, and posturing and beating chests and all of that kind of stuff. But what they're really saying to the rest of the world is back off. Back off, or we'll do the same thing to you. So we've become the scapegoat. Not a good thing for us, I might add, but we have become the scapegoat. So I thought that's an interesting proverb that I would put up there for you as well. But let's put China aside. Let's talk about the economy. The economy is on the up. This is household disposable income per capita. And you can see there that, we've really started to pick up in the last little bit. We're starting to see that rise, which is a good thing. We're seeing household savings. I talked about this last week, and how household saving is well and truly up. And that's a good thing for the individuals, but we want to see the business confidence up there as well. And this chart here actually shows even the US. The US is in very similar circumstances. The amount of confidence and money that's flushing around in the economy, that's what's creating the confidence. This is this printing of money that's going on there in America. But the big thing that I like to see is the consumer sentiment. So consumer sentiment is definitely up. Even though savings are up, consumer sentiment's up. We expect things to be going great. But look at this. This is business sentiment. So this is the business sentiment that has been increasing, as we've come into 2021. And that's most exciting, because it's business that's going to employ people. It's business that's going to create jobs. It's business that's going to make the big difference out there in the economy. So this is really a chart that I want to see and I want to watch on an ongoing basis. And that's translating. It's translating into jobs. This is a chart here from Indeed, and you can see there, the increase in jobs that are now being advertised, and that correlates with business confidence. There was a bit of a dip there with the second wave and other things, and a massive dip over here where we went into the shock wave of COVID, but it's starting to pick up. This is actually a chart you can see here of how quickly job ads are starting to pick up compared to GFC, the global financial crisis. And you can see there it took a long time for business confidence to be back up to start employing people during GFC, whereas COVID, it was very swift. So that means the recovery is also going to be very, very swift. And that's translating into pricing. This is the latest chart of house pricing. This is through to the end of February, we see there, and you can see there on a year-on-year basis just how much the cities have gone up in value. I mean, God, look at Darwin. Darwin's actually moved a lot. But you can see across the board, there's been a massive increase in over the last 12 months. So that's a good thing, and we're going to continue to do that. What is a more timely indicator is clearance rates. So these are clearance rates. You can see right up to the 21st of December, you can see how quickly things are actually clearing, and it's increasing. Now, clearance rate is basically something selling, goes to auction and it gets sold. Our biggest problem at the moment is supply. It's not sales, it's supply. We don't have enough to sell. You ask any real estate agent around the country and they're all scratching to trying to get listings right now. Sales volumes are up, which is predictable. But the biggest problem that we're seeing right now, as I say, is supply. Listings are down. The poor guys have got nothing to sell. So the market's been good. The market's going to continue to go up, and that's actually. I mean, I've talked before in these market updates. I've talked before about the what do you call it? The builder's grant, which is ending at the end of March. A lot of people have been rushing in for that to try and get the $15,000. Prior to that, it was the $25,000 up to the end of December if you signed a building contract on your own homes before then, or a renovation contract. Now it's the builder's grant, and that's going to be finishing at the end of this month. So there's been a big surge there. And what we're noticing, and this is really kind of cool, I like it because I've got kids, I've got adult children that are getting in the market, etc., is there's been a big demand, an increase in guarantor loans, where parents are guarantoring their children into loans. Now, I think there are better ways to do that. That's probably a topic for another day, where there's legal contracts that can be put in with the child rather than guarantoring their loan. But it's certainly an opportunity for those kids to get in, and that's what we're starting to see here. Westpac has tipped a jump of 20% in Sydney and 18% in Melbourne over the next 2 years. So, that's what they're predicting in house pricing. And that is why the parents are going, guys, you've got to get in. We'll help you get into the market, because this is the massive surge that we are in for, which is why you need to be educated, you need to be taking action, and you need to be doing it now. You can't afford to wait. You cannot outsave this period of time. The market will outpace you. And, when you understand how you can get into the market with or without money, it changes the ball game. And that's where I want you to be. Now, as I said, during the week we had the Women's International Day, Women's Day. So I thought I would give you a little bit of a history lesson here about the witches and alewives. What on earth is that? Look at this. Women have been categorised as witches for a long time, with the big hat and the big nose and all of that kind of stuff. I want to tell you where it came from. Back in the 15th century, women used to brew beer. And they used to sell it at the markets. And they were known as the alewives. The alewives, because they made beer. And they got quite financial making beer. They made a lot of money. And they used to dress up like this so that in the markets people knew that they were selling beer, so they could go to them. Then what happened was that the men in the hierarchy recognised that all these women were making all this money from brewing beer. So they needed to get in on the action, and they started the first brewing companies. Now, as a smear campaign to try and get the alewives out of the picture, they started this story about being witches. And, over their broth and cauldron, and they're stirring their potions and whatever else. Well, guess what? It worked. So back in the 15th century, there was this massive smear campaign against women because they were getting financially independent. So that's where the financial independence and how we've been slammed about getting ahead and all of those things has actually come from. The men wanted to get in on the action of making money out of beer. So there you have it. Now you know where witches came about, and the witches and alewives. So there you have it. Bit of fun there to finish up on. But I tell you what, the next step is for you to actually book an appointment with one of my advisors in I Love Real Estate. Let's get your situation sorted. Let's get a little bit of an overview of where you're at and where you want to go, and see what your options are to move forward. There are some opportunities there to take up some appointments. There's the link. It's iloverealestate.tv/questions/. Jump on there, make an appointment. There's only a few appointments there. there because I've set a certain amount of appointments for the advisors to be able to help you move forward and work out what you need to do to get that financial freedom. So that's it from me. That's my Intelligent Property Investor weekly masterclass. I hope you enjoyed it. It was a bit of a short one this week, but I'll be back again next week to help you out with some of that stuff. So make that appointment. Let's get yourself assessed and see where we go from there. Bye for now.